everyone wants to start with $100 account or whatever. And the truth is, like, if $100 is all you've got in your trading account, go and make some more money. Like, go and figure out how to make more money, because even if you get really successful in your trading and, for some reason you're able to generate huge returns on that $100, right? Because you haven't managed vast sums of money, you're not even going to be a good trader when you get investment, because you've only got $100. You've only ever had $100. You don't have the mindset to manage large sums of money.
All right, so welcome back everyone to episode 9 with Jason Graystone. Once again, one of my most inspired traders to talk to, someone who's really good with like goal achieving, building wealth, kind of has the goal to build a big empire and work on trading at the same time. So Jason, welcome back on the podcast. Good to have you here. Good to talk about trading again. Gonna be a lot of fun. So
thanks for having me. Man. It's always a pleasure catching up with you, and congrats on 100K on YouTube. Amazing.
I appreciate it. It's been a big milestone. It's been a pretty good step to achieve for sure. Good to have you back, of course. Good to discuss stuff about trading again. But I want to kind of start with what's been going on since we last spoke and we last kind of touched base a few months back.
What's been going on? In my trading, in 2022, I had with trading, my goal is always to become better and better as a trader. And what I mean by that is like, I want to be able to add my discretion to my trading year upon year, and ultimately take more trades that are right and have less drawdown periods. And 2022 was the best equity curve in my trading that I've seen to date. So I took fewer trades, but I was right a lot more, and my drawdowns were lower. So I had a really, really nice equity curve, and long may that continue. I hope that that's the way that it's going to keep going for me. And the start of this year has also been going that way. So really happy with the trading. Obviously, I run my Tiers of Freedom program where I'm helping people build wealth and teach them more kind of investing strategies and personal finance. And then Tier 1 trading is going really, really well as well. So yeah, great year since we caught up last. Good in trading, good in business. So just excited for what the rest of this year brings, really.
So tell me more about this. It's going to be a fun kind of perspective on trading. So a lot of people start more discretionary, I feel, with the trading. They start more with like no plans, very simple. Then they go on and kind of maybe go into systems a bit more. At some point, they kind of maybe go back to discretionary a little bit. How does that work out for you? Is it a stage where you want to bring back discretionary because you have an edge with it? Or what makes you want to go back with this kind of trading?
To me, I don't believe that you can just start trading with discretion. I don't believe you can, purely because I'm not saying you can't. I'm saying that you need a lot of money to be able to do that. If you're going to trade live money, you're basically learning on the fly. Whereas it's much better to develop a system of rules, and then build discretion on top of that. So reviewing, optimizing, just putting in the reps every day, journaling, identifying things that happen frequently. And then after, in your review process, you might say, well, you know what, I was a bit too conservative with that, and let me check how that's played out in the past. And you find I'm way too conservative on that. So I know that if we hit this level, I can be a little bit more aggressive. And that to me is what I call earning discretion. I don't think you can learn discretion, and I don't think it's something you can build a trading plan off of, or it's not a wise idea to anyway, because as I say, you have to have a lot of money to do that, and it's pretty pointless. Whereas if you can add it and earn it over the years to your trade plan, to your system, then that's a far wiser way to approach it. And that's what I do every year. Every summer and every Christmas, I spend optimizing my strategies and seeing where I'm leaving money on the table, how I can increase my aggression on each trade without being overly aggressive. And I'm always just trying to tweak it. I kind of say it like, when the heating's too hot in your house and you get the people that turn the stat right off and then right up, and then it's too hot, too cold, that's not the way to use a thermostat. The way to use a thermostat is to tweak until you're comfortable. And that's really how I approach my trading performance. It's bit by bit by bit. This is a long game. I'm going to be doing this for the rest of my life probably. So I'm in no rush. I want to make certain tweaks so that I can ultimately end up with a solid equity curve, with hardly any drawdowns, maybe not as many trades, but right a lot of the time.
A lot of traders feel like discretion can be sometimes hurting the trading, or they feel like every time they take a trade that's a bit more discretionary, they kind of miss out or they take a bad trade because of it. How do you kind of make discretion useful for you in trading?
You just touched on the key point, missing out. I think that people who go down the route of discretionary trading are trying to rush into trading. They can't be bothered to do the work to actually build a system and go and prove that it's profitable over time, and then go and build discretion on top of it. So the fear of missing out is the elephant in the room, in my opinion. If you're trading and you've got a fear of missing out and you're worried that you aren't getting involved with opportunities, address that first. Make sure you could either take a load of trades and be very active in the charts but lose money, or you can have a system that you've got confidence in and isn't going to play on your mind when you go to bed at night and generate profit over time. That to me is the goal. I always say, like, if you're in a trade that's keeping you up at night, you shouldn't be in the trade, and it's pretty much common sense. But I think when you're just a discretionary trader, you don't know what's going to happen next. So how can you possibly ever have peace of mind purely trading from discretion? And again, discretionary trading indicates that you're not journaling anything or learning from anything. So how do you develop and grow and progress? Like, I don't know. And I'm not saying that, I'm not saying that it's impossible. And I know there are some great traders that have learnt discretionary approaches over the years, and they're very professional about it. But most traders, come on, let's be serious. Most traders that mention discretion, they just want to know what the market's going to do. They just want to feel like they just can't be bothered to do the work. That's what I've witnessed anyway, working with thousands of them.
This is probably going to come from more of like a beginning trader who wants to, or they want to be like sticking to a system. They want to make money with trading, but then they find the system they have boring over time. Like they trade it for a month or two, then it gets boring, gets the same thing repetitive. How do you kind of avoid that feeling of kind of being bored with the same system that you have? Kind of, then you make it more interesting.
To make it more interesting, I think whether you're in business or whether you're a trader or whatever it is, right? Write this down. When things are boring and monotonous, that means profit. That means sustainable profit. When things are exciting and exhilarating and very kind of emotional, that's when you're probably either making big sums that aren't sustainable, or it's just it's very volatile. Your plus your gains and your losses are very volatile, and we all know that human beings can't handle volatility in their emotions plus or minus 10%, more than that. So you want to really keep your equity curve plus or minus 10% from your average growth. Otherwise, you are going to become excited. Now, that doesn't mean to say that you shouldn't enjoy trading, right? You should enjoy trading if you're doing it. And the way that you keep that spark there is just constantly learning how to optimize, how to build discretion, how to review and journal and see where you're leaving money on the table, and understand how in the future you can start generating more profit by slowly dialing in that discretion. And that to me, looking at the markets is enjoyable for me. And I would say if it's not enjoyable for you, you want to question whether or not trading is your thing anyway.
Yeah, so there's a big difference between being enjoyable and exciting. Like those are two different things.
Totally.
You're totally right on that.
Yeah. I would say you don't really want to be excited by your trading. Excited. Every time I've been excited, there was a time in April the 3rd in 2020, I had my biggest trading session, and I got a bit excited then, and I had to actually stop trading the lower time frames, and I haven't actually traded them since. And that was because I recognized that I was excited and what damage that could have done to my performance, or maybe I could have given back all that money to the markets over the next couple of years. So I went just back to my swing trading strategies and my higher time frame stuff. So if you're excited, let that be a warning. Just don't get too cocky. Don't get too because it just you'll develop fantasies about your trading, and you might start shooting from the hip.
You mentioned that plus or minus 10% on your equity curve that people are comfortable with, and I feel like there's two extremes to it. There's people who want to have who are willing to tolerate big drawdowns, like they feel like they can handle like a 30-40% drawdown if they can make money overall. But then when they get there, it's like they just cannot handle that anymore. Because they didn't really kind of they couldn't really see themselves with that kind of drawdown. Then when they get there, it's too hard for them. Or there's like the opposite where people kind of feel like you should have very small drawdown and very big upside, and that is kind of also very hard to achieve. So, kind of, I guess, expectations, or how would you kind of explain that better?
Yes, there are certain people. I've got a friend who's a great trader, but he is the type of person who he will take a 50% drawdown and he swings and swings and swings in the hope that he connects, and he connects and makes back double, triple what he's lost. And that's great. But for most people, they can't do that. And it's purely because there's been studies proven that humans can't tolerate fluctuations more or less than 10%. So, for instance, if you was, and this is in anything, by the way, it's not just money. If there was, if you had 10 friends and you lost 10% of your friend group and you fell out with someone, chances are you'd be a little bit, oh, all right, whatever. But if you lost 3 of your friends, you would start to feel a little bit emotional. Same way as if you was paid £1,000 a month and I paid you £900 instead, you might be a bit peed off, but you'd probably tolerate it. But if I paid you like 800, 700, you'd start to really be like, no, this is affecting me. Same goes for if I paid you more. If I paid you £100 more, you might not be too cocky. But if I paid you £400 more, you might splash the cash and drinks on me and quickly get rid of it, right? So you become a bit cocky. Same goes in your trading. When you're trading, fluctuations greater or less than 10% in your equity curve or the volatility in your account, you're going to struggle with that. So what I would say to your question is just assume, if you're starting, just assume that you can't take more or less than 10%. And then if you find out that you can, then great. But just be aware that if you lose 50% of your account, you've then got to make back 100% of your account. And that's pretty hard to do. The quickest I've doubled my account in is just over 18 months. So, 19 months to double my account. And I did that. But that was the quickest I've ever done it. So just bear that in mind.
Good point for sure. What would you say? So I see a lot of people who want to trade chart patterns, I believe similar to what you do, but they have a tough time making it like very systematic. Because for them, chart patterns are just like you look at the wall tops, look at these things and that things, and you kind of mix it all together. And it becomes like very kind of blurry and very not clear what they trade. So how can you make something based on chart pattern that's kind of at the basis fairly discretionary? How can you make it more systematic or more kind of like process driven?
For an example, let's just say, I was just talking about this earlier today. Let's just say that you trade off of structure, which is a very popular approach. You're trading off of major highs, and you're shorting the big highs when they're retested. Let's just say that you approach it in 4 different ways. And the first way is just a limit order, right? So you just place a limit order, and as soon as price touches that level, you're short, right? And you've got your stop loss here. Maybe you place a 2-to-1 reward to risk or a 1-to-1 reward to risk, and that's your rule, right? Then you might test that and you might say, well, actually, I'm going to test levels of aggression. So that's the most aggressive. The second most aggressive would be like a 3-bar reversal. So you're waiting for the market price action to give you a signal that we've closed. We've had some indecision, and then we've put in a lower low and a lower close on the open market, and then you get in the next bar market. So that's kind of a wait at market situation. And then if you're a little bit more conservative, you could say, well, I know we've had the 3-bar reversal, but now I'm going to wait for a retest. So I'm going to wait for a double top. And that would be your third level of conservativeness. And then even further, you could say, well, even though we've had the double top, I'm going to wait for a violation of the retracement on the double top and then another pullback and then set a limit order. So there's all these different things that you can test. And this is the beauty of the markets. You can go and test those rules. You can say, right, okay, if we test previous structure, I wait for this, then I wait for this, and I wait for that. And, I'm going to track all of the results, and I'm going to pick the one that suits my personality best. My personality meaning I get a nice amount of opportunity, so I get a lot of trades or few trades, depending on what you need. My reward to risk profile, and you can test different reward to risk profiles. So you can do all this stuff to suit your personality so that you're not out there trading something that goes against every fiber of your being, because trading's hard enough. It demands enough from a human being that isn't part of their makeup. So you definitely want to have some rules there. And I would say to add discretion to that, then you just trade it. You trade it and see what happens, and it has a profitable edge because you've tested it, and now it's just a case of, well, how could I be a little bit more aggressive? How could I get involved with more of these setups? Where am I leaving money on the table? Do I need to give my stop loss more breathing room? Do I need to tighten my, do I need to extend my target? Am I coming out of the trade too soon? And all of these things can then be discretionary rules that you can then add to the system to make it more profitable.
I see a lot of people who have the problem of not having enough trades to take in the market. Like they feel bored because of that. So do you have any thoughts on how can you add more trades to your trading without kind of sacrificing your strategy or the edge behind it?
There's two ways you can do it, really. Most obviously, without kind of putting in years and years of discretionary building so that you can become more aggressive. I would say there's three ways. One, you trade more markets with the same strategy. Two, you trade more strategies on the same market. Three, you trade lower time frames, where you're going to get potentially more opportunity. And then four, obviously, just build the discretion, earn the discretion to become more aggressive so that you know the breathing patterns of the market a bit better, then you're more confident in taking more. You're more proactive on setups, if that makes sense.
Interesting. What do you think it takes? Very general question, but what do you think it takes to kind of learn the market, like learn how the market behaves in a more discretionary way? Is it like observing the charts? Is it like time on the weekend, even without like being at the charts taking trades? Or what do you think that it takes to do that?
Yeah, I mean, yourself, when you put many reps into the market, right? Well, you're just looking at the markets every day, doing your analysis twice a day. You're going through your pairs every single day, and after a while, I don't want to say like I know what the market's going to do, but you kind of get this. Like there's, for instance, there's periods of time where I just know there's not going to be any trades that week, and I'm usually right because it's just a patterns that I've seen so many times over the years. And that's why I say you have to earn discretion. You can't learn it. You have to actually it's experience, right? Like you can learn to drive a car, but when you go out on the road, you don't necessarily, you learn how to drive on the road once you've passed your test, right? Same with anything. So it's the same in trading. You build discretion when you're out on the road, when you're learning. And the way that you build that is by putting lots and lots of time into your system, not making adjustments too quickly, just reviewing and making notes of where you could make adjustments, and then doing a full review and saying, right, where am I leaving money on the table? How can I become more aggressive? How often was I right? How many trades did I take? Out of those, how many did I miss? How many should I have taken? And the ones I did take, what about this entry technique or this entry technique, or what about multiple targets? And all of these things can be then added into your system to make you more aggressive, to make you more aggressive.
Interesting stuff. Yeah, it's something that people feel like they could get taught, but you cannot really get taught that perspective. It's very hard. Usually when people get taught that kind of discussion, they kind of feel like it's too hard to grasp, or it's a little bit too messy to learn. So definitely something that you have to kind of go through by yourself.
If you want rules for discretionary trading, just start with like price points. Because here's a little example. So one of my first early discretionary, implementations, if you like, was just certain price points. So I would look for a double top at certain levels, right? But if it hits certain price levels, which I'd had written down on all of my markets, I would say I don't look for a double top at that. If we test that level, I'm going to trade a 3-bar reversal instead of a double top, because if I wait for a double top, I'll miss the trade. Does that make sense? So there's certain price levels that you can pay attention to. Just draw horizontal lines on your charts and say, wow, this one's been tested, 10, 12, 15 times on the way up. It never seems to break through. Because another thing, certain price points are more powerful as resistance than they are support, and some price points are more powerful as support as they are resistance. So notice that, take note of that, and when your strategy comes to set up in that level, you don't then have to wait for all of the setup. You could just become a little bit more aggressive and go, if I wait for that at this level, I'm not going to hit the trade because it's going to go off without me. So therefore, I can adapt my rules. Does that make sense?
Yeah, definitely. The other thing I see is with these levels, a lot of people are kind of blindly putting levels on the chart, like all the levels they can find, they'll like put a line on them and want to take trades there. So how do you, I guess the question is how do you kind of figure out which level is likely to work or less likely to work in the market?
Yeah, me personally is I just look at, so again, it's all about journaling ideas. So I go, okay, I missed out on this trade. How many trades did I miss out on? And the price went in the direction that I predicted. Okay, so let's just say there's 3 trades that all went in my favor, but I didn't get involved because I was waiting for a certain entry technique. I can then go, well, where were we in the market? I can go out to a higher time frame, which will obviously have more power in terms of structure. And I can then count how many times price reacted at that level. And then I can go drill down the time frames and assess what happened at each of those points. And if there was no double top there, guess what? I was stupid waiting for a double top because I'm missing out on a trade. Whereas if I just set a limit order or a 3-bar reversal at that price point, next time I know that if I do that, I'm probably going to catch the trade and bank some profits.
This goes back, like you said, to journaling and also, I guess, reviews. Do you have any kind of process for reviews of your trades on the weekend? Things you do like outside of trading hours?
Yeah, I review my trading. I review my trades every day, and then I do a weekly review. And my weekly review is more about journaling to make sure that I'm always making no errors. So 4 main things that I look at is mistakes due to excessive loss. So if I took more loss than I should have, I'll note down how much I lost extra as a result of not trading my plan flawlessly. The next thing I'll look at is trades that I missed that I should be in. And again, I'll note down how much I would have won or lost as a result of missing that trade. The next thing is trades that I was in that I shouldn't be in and how much I won or lost as a result of that. And then trades that I managed incorrectly. So I review excessive loss, trades I wasn't in that I should have been in, trades that I was in that I shouldn't be in, and how I managed the trades. And really, I tally all that up and I try and keep it at 0, a flawless traded system.
Are you more a fan of paper or is it more like a online kind of based journal that you have there?
Yeah, I use Google Sheets. So good old fashioned Google Sheets. I've got a very comprehensive sheet in there, which actually tells me when I can become more aggressive and to what degree I can become more aggressive. So it's pretty cool.
Tell me more about this. So you have a way to know how you can enter early on the move or how you can put more risk on some trades, or how does that work?
Yeah, not how to trade, but it basically reviews my trades and then it takes into account my prediction, how often I'm right, what ones I got involved with. It takes into consideration trades that I've correlation risk, so trades that I've stayed out of because of correlation risk. And then it has a series of strategies and different target levels, target strategies. And once I fill it all in, it will tell me, well, you've left this much money on the table. And then I can start to analyze why I'm leaving money on the table and how more aggressive I can become on that particular strategy. And again, when I do the review, if it says that I can become more aggressive to the tune of 2%, I won't go 2%. I'll maybe go 1%. And then again, it's the whole thermostat analogy. So very, very slowly and slowly catches monkey. That's my approach.
This is the other fun thing is a lot of traders don't track the trades that they don't take or the trades that they miss because they feel like, oh, it's just the trade that I take that matter, the ones that I actually entered. But they could be either leaving profit on the table or maybe they're doing a good thing by missing trades, by avoiding them sometimes.
Exactly. That's where you're leaving the money, right? You want to become, my goal, and I've realized this more over the years, ultimately you just want to become more aggressive and more certain in your trades and be right more than you're wrong and have less drawdowns. That's it. So that's what I'm working towards. And the way you do that is by tracking everything I just told you. It's not only the trades that you was wrong at, but trades that you've left that you could have made money on, that you could have adapted into your system. That's real discretion. That's true discretion. Real discretion isn't putting your finger in the air and just thinking you know what the market's going to do, because no one knows what the market's going to do. If you think you do, good luck.
So I'm guessing you also keep track of your screenshots or some kind of trades examples you've taken to kind of look at how the setup looks like.
Every trade. Yeah, every trade, every prediction I make. So I literally do a daily prediction, up or down. Simple as that. That's on my daily swing trading account. I also take screenshots of every trade that I order that I placed, even if it triggered or not. I take screenshots of trades that I was involved with, and then I sometimes I'll do Loom videos of trades that are setting up that I think are going to play out but aren't part of my trade plan, so that I've got videos for ideas and discretion. So it's constant work. Like it is. I know people think trading is, once you've cracked it, you've cracked it. You never crack it. Like you never ever get to a position where it's like, I completed it. It's constant. Like really is constant.
You have for sure a top-notch journal here that you keep track of, and I'm sure that's amazing. And I probably am the same. Like I do the same thing too. Like very, not fancy, but like very detailed sometimes. But for new traders that kind of might be somehow intimidated by this, but they might seem this is like too difficult to keep track of or too intimidating. Do you have any kind of advice for them on how they can journal like without being too over the top with it? At least in the beginning.
Yeah, just track the basics. What I would say is track the market, track the market, the instrument, the entry price, the exit price, the stop loss and the target, the winning profit, the date and the time. That's a must, because back in the day I remember not tracking the date and the time, and I wanted to go back and like tweak and tune something, and I just had to redo it all because I couldn't find anything on the charts. So don't do that. Don't do that. So date, time, entry date, exit date, entry time, exit time, any notes that you might feel are relevant, the method of entry, those are enough to start going on, and then you'll develop from there. What I always say to people who start testing and journaling is you're going to think of other things. It's like a catch-22. You kind of have to do 2 or 3 rounds of it before you've got everything there, and then you can just move forward and test that on everything. Because you're always going to have ideas. Yeah. So I remember like you'd go through it once and you go, oh, what if I did this? And then you'd go again. Oh, what if I did that? And then you'd go again. And eventually you kind of iron out all the thoughts, and then you've got a solid thing to go and test.
And the other thing is kind of figuring out if you have any kind of quality for your trades, like a quality factor for your trade. Is it a good trade or a bad trade? If you make any mistakes there, or are you taking this trade with your plan? Definitely useful. Yeah,
qualitative analysis, things like, how many tests of structure, like number of tests of structure. Things like you might use, you might use indicators. You might use a MACD indicator. You might use an RSI indicator. You might use something where it's going to add quality to the trade. You might have an even handle number. The quality of the entry. As I say, you might like a really high test candle. And how high test is that candle? Do you need the close in the lower 30% or the lower 50%? And so there's all these things that you can add to your qualitative analysis. Just those are things you just add as you go on.
What are some of the common mistakes you see that people that you coach make with regards to trading? Are there like a few things you see that you spot are very common that people make mistakes on?
Making mistakes, making mistakes, like literally placing the wrong order or missing a trade that they should have been in. I'm coaching someone right now. He moved across the other side of the world with a ton of cash. He funded his trading account with over £1 million. So he's got a 7-figure trading account. And one of his mistakes that he makes is missing trades, because he now lives in Australia and the time zone's very hard. And now he's struggling to hit the trades. So he's waking up late or going to bed early or whatever, and he's missing trades. And that is costing him a lot of money, because the last thing you want to do is hit a drawdown and the drawdown's bigger than it needed to be because you missed trades that would have kept you above water for the month. And that's basically what he's doing. But what that causes is revenge trading, right? So revenge trading is a really, really popular problem. It's like a pandemic of traders where they take too many trades. They chase the trade because they missed out or lost money. But then again, there's also something called under trading, which is basically you get scared out of the market and you should be taking trades, but you're not taking them because you've been scared out of the market, or you've lost some money, or you've had a massive win. So you've become cocky and now you're not taking trades that you should be in. Well, we all know as traders, you need to be focused on profit over time. So although you're not taking trades and you're not losing money, what about when the next big drawdown comes? You know, are you still going to be making up that average profit return over time? And you won't be if you're not taking trades that you should be in. So that's another common one.
That's a good one. How would you say we can overcome that kind of under trading perspective? Because we hear a lot about the over trading. It's very popular. Most people kind of trying to get out of it. But how about the other side, the under trading? How do you kind of get out of that?
Just reviewing your trades. As I say, go through your trades, review them, make sure that you're connected to the past performance so that you've got confidence in how your system performs and what you should be doing in order to maintain that average performance in the future. If you take a big win, well, you know, look back at your past performance. Have you taken a win like that before? If not, well, you know, make sure that you carry on trading how you should be, because a big loss could be coming, right? And you need to average out the performance. So yeah, just staying connected to your system, journaling, reviewing, making sure you're constantly looking at past performance to stay grounded on what happens, you know, what is likely to happen, because it's the same for losing streaks. If you've lost 7 trades in a row, that can be really tough. But then if you look back at last year and you took 10 losing trades in a row, and the year before that you looked 10 losing trades in a row, well, then you know you're still not even at your maximum, and it keeps you a little bit calm knowing that. It's not easy, but then trading isn't easy. So.
That's right. And when we kind of focus on a specific trade that we want to avoid and like not take, we tend to forget that like over a week, over 2 weeks, that could have been completely paid off by other trades or other wins we've taken. So what I found helps is like going back on the market and kind of figuring out all the trades for the past 2 weeks. If you took all of them, what would the results be? Then you compare this to whatever results you had by not taking some trades. And usually it's better if you took all the trades anyway, most of the time.
Exactly. That's why in my review, I'm always looking at trades that I should have been in that I wasn't, and trades that I was in that I shouldn't have been in.
Definitely a good point there, for sure. We talked about time zones a bit before, but how do you feel like time zones affect a trader's performance? Do you feel like some traders, because they live in whatever, Australia or some other place, could be kind of have less advantage than people living in, let's say, London or whatever, because they have a better time zone to place trades?
I think Australia's all right, actually, because you can actually trade the London session in Australia. It's in the evening, obviously, or in the afternoon, but Australia's not too bad. I think I prefer being in London and Europe, because for me, that captures the London Open and the New York Open. And I think what I find personally with my trading is there's a lot of setups that we can be on top of in the London session, even though they play out in the New York session. But because I'm awake for that, I just get that extra preparation. I'm not waking up and trying to do my analysis as the market's opening. So, I'm biased, but I prefer the London session. And I would say, depending on where you live, just make sure that you pick something try and make something work that has volatility and movement, because obviously if it's flat, you're not going to make any money. And second of all, just make sure you can prepare and plan for the setups before one of the big major opens. You know, the London and New York crossover's the busiest time, right? So that's try and make that work, I would say.
Yeah, it's interesting because I hear that excuse a lot of people saying, "Oh, because I live in this country and that country, I can't be trading profitably because I missed these sessions at these times." And I don't think it's a fair excuse to be honest, because I think there's ways to go around it. At the same time, yes, you could miss some trades because that session, of course, you're gonna trade like London if you're working that time or whatever. but I think it's still a way to go around it.
Yeah, I mean, you can't say I'm not profitable because of that. But, you can make anything profitable. It's down to you to make it profitable, but it's much easier to blame the time zone, right?
Definitely. Yeah, if you wait to move to a different place to be profitable, it's going to take a while, so for sure. So I hear this question a lot about people having too many options. Like they have all these strategy ideas they want to trade or they want to test, but they just don't know which one to kind of focus on or which one to pick. How would you tell them to kind of go from having so many options to maybe like focusing on one thing and trading it?
Yeah, it kind of ties into your last question about, different time zones. You want to pick something that moves. If you're just coming into trading, you basically want to get some data that tells you, you want to pick a strategy and you want to go and test it on a market to one, show you the performance of that strategy, but two, build your own kind of identification recognition for the setup and play around in the charts, right? So for that, you want a lot of opportunities, and for that, you want movement in the market. So if you just picking first of all, I'd start off saying you want to go for one of the major pairs, right? So pound dollar, euro dollar, Aussie dollar, pound yen, something that's kind of moving a lot, and then you want to pick a time zone where it moves. So if you was to go for some exotic pair, like, I don't know, some unheard of, maybe the rand or something, and you go into the Asia session, the chances are it's just going to be dead. It's going to be flat. No one's trading that market. So you're not going to see the setups. So you're not going to get the practice. So you're not going to get inspired by the opportunities. So first of all, just pick a major pair and then go and pick a time frame that will give you some movement, and then start there and start in a session, either the London session or the New York session, not the Asia session.
Yeah, very interesting. I think there's a lot of good stuff about the Asian session too in a different perspective. But yeah, definitely if you want to make it easier and kind of focus on a major pair, I think that's a good way to go about it for sure. And kind of maybe trying things off. There's nothing wrong about having too many ideas as long as you don't try to trade all the same time and the same day. But kind of going through it over time, making a list, that could definitely help to get more systematized, more focused.
If you do too much at once, it's a recipe for disaster.
For sure. Anything we didn't focus on or talk about you want to mention or kind of touch on a little bit?
I would say, I've got a lot of people come to me lately asking about trading, and the most common one is starting undercapitalized. Like, everyone wants to start with $100 account or whatever, and the truth is, if $100 is all you've got in your trading account, go and make some more money. Go and figure out how to make more money, because even if you get really successful in your trading and for some reason you are able to generate huge returns on that $100, right? Because you haven't managed vast sums of money, you're not even going to be a good trader when you get investment, because you've only got $100. You've only ever had $100. You don't have the mindset to manage large sums of money. So the first, it's an elephant in the room type scenario, because they're like, well, if I have 100, I could focus on getting good returns and then I could go and get investment. You're missing the point. If you've only got $100 to your name, you've never ever appreciated growing capital, or you've never had vast sums of money to manage. Therefore, you're not going to be able to manage them for anyone. So that to me is a big thing. I think it's a big common approach, and I think it doesn't work. So go and see how you can get more money first, and then come back to it. No, people won't like that answer, but it's true.
Totally agree with that. And I realized over the years that it's a lot easier to trade when you have a way to fund your trading also, when you have a way to fuel it over time. First of all, you can grow faster that way when you have other incomes coming in to kind of help you boost your trading. And when you don't have to rely just on that trading to kind of make money necessarily. So
absolutely. Yeah.
Speaking of which, do you have any kind of process or rule of thumb on how often you're going to put money in your trading account, or how much you're going to put at different intervals? So how do you kind of decide when you want to put more money into your trading account?
Yeah, my trading account's quite dynamic. So it will depend on different motivations that I've got during the year, really. So when COVID hit, for instance, there was a lot of people, pulling out of the markets, and there was a lot of uncertainty in the markets, but there was also a lot of opportunity in other businesses that I then thought, well, I'm going to put my money there because there's more opportunity there right now that gives me some certainty than being in my trading account. So those types of scenarios, I'm always dynamically kind of rebalancing my portfolio, including my trading account. There's also times where, if I had a massive winning streak in my trading, I can increase my position size, and I'll look at funding my account. I don't usually do it off the back of a big winning streak. I normally do it off of as I'm coming out of a losing streak, more to the point. But my position size is dynamic as well. So if I go above a certain threshold in my equity curve, I will increase my account balance. But for me, my trading account isn't something that I'm always growing these days. It's something that I use as a vehicle to get great returns on, and I use the skill of trading to get great returns on, and I've got the cash there to then use for wherever I see the next opportunity. And I'm not saying that was my agenda all along, but now, as I've built my account to a healthy size, I can now use it for more opportunities, which is more fun sometimes.
Yeah, definitely agree to do it. And you don't have to just put all your money into trading, which is also a good point. People expect that because they're traders, they have to put all their savings into trading and trade their whole capital, their whole bank account. But that's just not how it works.
Yeah.
You make a good point there.
Yeah.
Sure. Awesome. So where can people connect with you or find out more about what you do after this podcast?
They can connect with me on jasongraystone.com. But I would say if you're interested in learning, I put a video out on YouTube recently called Trading for Dummies or Trading for Beginners. And I put the video out. It was a 2.5 hour trading tutorial for people who are interested in trading. And we put it out and it's got 200,000 views, which is insane. It's completely free. Go and check it out. It's on my YouTube channel. Jason Graystone is my YouTube channel, and you'll find it there on the homepage.
Awesome. I'll try to put a link below the video here. People can check it out directly, or the podcast notes as well.
Appreciate that. Thank you.
Appreciate Jason. Always good to talk to you. Good to connect. I know we always have good topics to talk about, always different. So I appreciate your time, and thank you for the advice you gave to my listeners today. I appreciate it.